Jahangir Aziz, Head of Emerging Market Economics at JPMorgan. He's joining us here from the sidelines of the JPMorgan conference. Jahangir, thanks for joining us. You've been saying that the interest rate defense is required at this stage, given what's happening on the current account deficit and the exchange rate. I'm keen to understand why and how you think it'll work.
Well, almost everyone will agree that there are two different reasons as to why the pressures on the rupee are building up. One of them, of course, is domestic, that we have a rising current account deficit, and the other is external, that we've seen a global financial conditions tighten, and that in the month of August got translated into a reassessment of emerging market risk. I think where we differ is in the first part, which is what are the drivers of current account deficit. And I think the way we are looking at it is that, look, if you get into exports and imports and exchange rates and oil prices, you'll get completely lost in the weeds. There is another way of looking at the current account deficit, which is basically it's a part of investment that is not financed by domestic savings. That's the amount that we go abroad to borrow, which becomes the current account deficit. And so the question is, what is happening that has made the current account deficit wide? In our view, two things have happened. One, in the first 2 quarters of this year, we have seen some increase in investment. But at the same time, our sense is that both household and corporate savings have fallen, and government savings, which is basically the overall fiscal deficit, hasn't really moved very much. Consequently, that increase in investment is being funded abroad. So the question is, what do you do to bring down the current account deficit, A? And B, what do you do if the reason as to why there are these concerns is global financial conditions tighten? And I think you need to respond to both. And we're not saying that interest rate is the only tool. We are saying that if you have only one valve of adjustment, which is exchange rate, then we do know that that adjustment will be outsized, and which is exactly what's happening. So the adjustment needs to be spread across both interest rates and reduction in fiscal deficit. So I think we're not saying that that's the solution to everything, but that has to be part of the problem, and it's much better to distribute the adjustment across different areas such as fiscal policy, monetary policy, rather than let exchange rate be the only valve of adjustment, because then the adjustment will be very, very large as it's happening.
So you're not a believer, Jahangir, of the view that let the exchange rate adjust to a level where automatic stabilizers, etc., kick in, and that would be enough to balance out, at least on the consumption side, some of the issues about excessive imports on the non-core areas, etc.
This idea that at some point in time, Indian assets valuation will be sufficiently cheap because of the FX, and that will be the incentive for capital flows to come back into India, that could well be true. And if we go down that route, that we only allow one variable, and which is what I'm trying to repeat, that if we allow only one variable, which is FX, which is the only way in which valuations are adjusted, then that adjustment necessarily has to be large. My point is that there is another way, a much easier way of doing this, which will keep the adjustment on the exchange rate modest, or will contain the adjustment, which is a fiscal policy and monetary policy comes and plays a helping hand in the adjustment. If you don't do that, then yes, at some point in time, valuations of Indian assets will be cheap enough. But if exchange rate is the only way, or reducing valuation is the only way in which we are going to adjust to this, to the stress, then I think we might have a very long way to go.
So the other complication is with the use of interest rates in this current flexible inflation targeting regime. Inflation is seen about 4.5% at the end of the year. It's been underperforming expectations last couple of months. How does the MPC actually justify higher rates at this point in time? Isn't that a tough one? Not really. I mean, there are many inflation targeting economies in the world. India is not the only one.
If you look at inflation targeting economies in the world, they have been around for about 20 years. All of them face the same problem, which is that they have certain domestic variables, let's say in this case inflation and whatever goes into inflation, and because they're open economies, they also have external variables such as global financial conditions, US interest rates, etc., as part of a part of the inflation targeting framework. The problem is that India's inflation targeting framework is based on this antiquated belief that India is a closed economy, and therefore, within the inflation targeting framework, there is no reference to global financial conditions. What we have seen over the last 10 years, repeatedly, 2008, during the Lehman crisis, 2011, the European sovereign debt crisis, 2013, the taper tantrum, now that India is not an open economy. Now, I go to any inflation targeting open economy central bank, they do respond to, obviously, to domestic variables, inflation, growth, slack in the economy, inflation expectations, the whole host of them, and separately and explicitly, they also react to global financial conditions. And I think that's the problem, that because we think that we are an open economy, a closed economy, but in reality we are not, is this inconsistency that we get, that when we do inflation targeting, we think, well, you really cannot respond to global financial conditions until and unless domestic variables change. And I think that redesigning has to be done, but I don't think that there is absolutely any inconsistency between looking at inflation domestically and responding with interest rate to global financial conditions.
All right, Jahangir, on the import-export side, the other thing that's being considered is some sort of import curbs or higher duties on imports. What do you think of that? Do you think something like that will work, and is it even advisable?
Look, let me get back to the way we look at current account deficit. We are looking at current account deficit as a lack of savings in the face of rising investment, that the saving investment imbalance has gone against India, and that's being reflected in the higher current account deficit. We don't think it's an export-import problem. So, those measures that the government or other analysts, etc., are suggesting, those to us are actually barking up the wrong problem. The problem is insufficient savings. The problem isn't that there is, whatever, non-essential imports are rising. I mean, I don't even know what non-essential imports are, right? I mean, so yes, I'm somewhat uncomfortable because we don't see it that way. I think it's the wrong description of the problem, and if that's the wrong description of the problem, then these prescriptions that are being provided for that problem, I'm somewhat uncomfortable with them. I think the real problem is insufficient savings, and that needs to be addressed.
All right. There's also, in the interim, short-term fixes being discussed. Jahangir, NRI bonds, FCNR kind of deposit schemes that were used in 2013. The problem there again is that if you keep going back to these so often, they're no longer one-time fixes.
That's correct, in the following sense, that the description that we are now that's floating around, right, among analysts and policymakers and market, etc., that magically in 2013 all of India's problems went away because they did this NRI deposit. If you look at what happened in 2013-14, it started out with a 300 basis points of rate hike. It was followed by a very, very large fiscal tightening that was squeezed into a pre-election year in the last 6 months. Only after that did the Indian government go to with the NRI deposit. And remember, the NRI deposit did not come without a cost. There was a massive subsidy provided to Indian commercial banks in order to make it lucrative for the Indian commercial banks to actually go and get the NRI deposit. So the idea that even NRI deposit in 2013 was the magic solution is actually incorrect factually. And if you go to the foreign markets and you say, look, I want $10 billion of bonds, or I want X billion dollars of non-resident deposits, or whatever you're looking for, but I'm really not going to move on my monetary policy. I'm really not going to move on my fiscal policy. And so, that money is essentially a substitute for not moving on policy. I really don't think you're going to get very many takers.
All right, Jahangir, last question. On the global front, what are the upside and downside risks to the environment as you see them?
Right. So I would say that, clearly the biggest risk right now is how the trade war, or, the trade tensions, let's not call it a trade war, trade tensions proceed in the next 3-4 months. We are focusing only on one side of it, which is obviously should be the case because it's close to our neighborhood, on the US-China trade tensions. But remember, there is also the Section 232 auto tariffs that are being studied, which is going to be global. Let's add to that we still do not have a resolution of the NAFTA 2.0. So my sense is that, unless all of these things get to some form of resolution, I think the heightened uncertainty is going to keep dampening business sentiment. And with that, I think both in emerging market as well as in developed market, that's going to have a dampening effect on investment. And I think that's the biggest risk. I think more immediate risk would be that I don't think any of the current account deficit countries, maybe Argentina, maybe a little bit Turkey, has really reacted so far to the tightening in global financial conditions and to the reassessment of EM risk. I think all of these current account deficit countries will have to follow up with much tighter fiscal, much tighter monetary policy, and that will necessarily have a dampening effect on their growth prospects. Maybe not in the third quarter of this year, but definitely in the fourth quarter of this year and in the first quarter of next year. So I think there are these near-term concerns. One, of course, is the global concern on trade, but I think as far as the current account deficit countries are concerned, it is a reaction to the policy tightening that is likely to come and the impact that is going to have on growth in the coming 2 quarters.